to the 5 minute and finding execution patterns, which were like different candles, 2 to 3 candles that tell you whether it's going to go up or it's going to go down. And I see that sometimes when I'm watching the lives, it correlates, but you guys are a bit more advanced. So I definitely want to learn more from you guys than I learned last time from the other mentorship.
Okay. Uh, what about your psychology? Do you find yourself having issues, let's say, holding trades or over trading, fear?
Yeah, so definitely more so now, because before with the other mentorship, they would tell us just watch the charts for 1 hour at 6:30 till about 8 at maximum, and just wait for one setup. So if we found one setup and it was on the 5 minute, typically we would be in a trade for maximum like 5 to 10 minutes. So it was nice, quick, maybe like 3 RR, 4 RR maximum, and then just get your maybe 100 to 200 bucks a day, and then just be done for the day. But now that I'm doing the live calls, I'm definitely over trading. So since I've been with you guys, I've been lucky enough to pass my challenge 4 times now. But every time that I do get to my challenge, I overtrade too much and I'm blowing my PA.
Right. Okay, I see where you're at right now. So I think a good beginning would be to kind of find a adequate system to work with, something that you can kind of follow religiously, and allow time to do its to give you its results. I get that you have your prior knowledge from your previous mentor. How familiar are you with the things that me and JD, let's say, do in our charts with ICT?
Sorry, could you repeat that one more time?
Yeah, how familiar are you with the ICT concepts?
Not too familiar, just more so when you guys are talking, I'll try to pay attention to as much as I possibly can. And I've only been on one of JD's live calls where he's taught us a couple of the models.
Okay, so kind of to just save time, I'm not going to reteach you the models. I think we have so much education of that too that you can kind of find your way through them. But I do think what we could talk about in practice is how to handle your next PA when you get it.
Mhm.
Because concepts itself, models itself, we have so much educational content about that that I feel like you can stand your ground, and if you have any questions, you can ask in any normal Q&A class. Uh,
Wait.
so let's work on something for your approach when it comes to the PA. Now, of course, there is the risk to reward system that you need to be implementing. One where you put yourself in a position where you won't overexpose yourself to risks, but also that you won't worry too much if you lose too much as well. So far you think your only one of your weaknesses is overtrading. Do you feel like there's anything else that's
Yeah.
kind of holding you back every time you have a PA?
Um, the other thing that holds me back is, let's say we're in a trade and JD likes to break even a lot. So when he gets out at break even, and sometimes I don't put a stop loss, um, I try to normalize the fact that it's either gonna keep buying again at that same point, and I stay in too long and then just completely changes its trend. And then that typically is what messes me up psychologically.
Okay, so
That's my other
overholding is
problem.
one of them as well.
Yeah.
Okay, so the way that we could do this is, from my own personal experience trading for so long, definitely less is more. Um, you don't really need to trade all the time, every day even. You only need to trade the setups that appear that give you the most confidence that you feel that they can just literally not fail. Ideally, day trading is considered one of the hardest forms of trading, and it's one of the less profitable forms of trading as well. Out of 100 traders that day trade, nearly 10 or less people are going to relatively make any money just because of how hard it can be. And with that being said, ideally, you want to have try and have a set target and a maximum loss that you'd be willing to adhere to without putting yourself in danger of losing the account. Because another thing is being able to stop when you're red, right? Usually, when you're red, you want to do anything you can to be green, and that sets you up for even more of being in drawdown in your account. So, I would say one of the things that you kind of have to put it like a rule to yourself. There's usually rules that we put to ourselves when we start doing day trading specifically so that we can follow them to the T, and that way we try and remove the human error factor in our system. Because ideally, as humans, we always make mistakes, right? We let our emotions cloud our judgment, and sometimes they become so big, the mistakes, that it becomes a point where you're like, either, whatever, I'll just restart again, or you kind of go haywire and you keep fumbling again and again and again. And ideally, with these laws that we set ourselves on, it makes a barrier so that even if you committed a mistake, you can't keep going. You just gotta stop. It's like a pause. So
Okay.
I think usually, since you're relatively beginning in futures and everything like that, you could set yourself to just being exposed to, let's say, 2 trades a day, maybe 3 trades a day, and then just close the shop. Because ideally, I I think when I'm trading or when JD's trading, we find our solid idea between 1 to 3 trades from the get go, and from there it's kind of we're green. You don't necessarily have to continue trading, especially because
Yeah.
in your own, since you're relatively a beginner, I would say, at least when it comes to like what we do, it's best to take things slow. I know that seeing a lot of
No,
big
that's being
numbers
alone.
might be tempting to, ooh, this guy's making thousands. I could be doing as much as him. But you got to understand that he's in a different path of his journey right now than where you are at. And if you try to skip to where they are, you're going to end up tripping over yourself and making big mistakes that you don't necessarily need to do. Um, an easy way to do that is to kind of try and find your system, which is obviously something you're going to be doing in due time. But first rule I want you to kind of put yourself is you want to limit yourself to maybe 1 3 trades a day, right? You want to make it so that if you were to be wrong in between one of those 3 trades, or if wrong in all of those trades, you're not going to be blowing your account straight up. So when you enter a trade, how much do you usually risk?
So at first I had been doing one contract, so I was trading NQ. And then later on, after I would get my PAs, I was just doing between 3 to 5 NQ.
Okay, so eval one mini PAs, 3 micros. Okay, that's not bad at all. Actually, that's, I'd say, great sizing for the PA. PAs usually, if you're doing a 50K, I assume, it's definitely best to have to use micros,
Yeah.
especially 2 to 3, as it lets you have more margin for errors. But in that case, what is your usual stop loss when you're taking those kind of trades in the PA?
So from what I had learned last time, it would be $75 maximum for my minis. I mean, for my micros. And then for my minis, it would be 150 maximum for the one mini that I would do.
$75.
But that's another thing. So I wasn't sure if to do it when we're in a trade and I see that you guys are down and I'm down the $75. If I should just close my trade or if I should wait until you guys say close the trade, which is what typically I've been doing is either I'll wait for you guys to say close the trade and I'll close it, or like I said, sometimes when JD breaks even, I'll just stay in the trade longer. And I think that's my ego thinking that, it's gonna go back up, but sometimes it does not.
Okay, so assuming you participate with 3 micros, that's almost a.
The stop loss used to be 30 ticks is what I used to do. 30 ticks.
All right, that's almost 14 points. Okay, so I think is that the issue there, stock management. That's one of the issues that you had, because flat
Mhm.
capital for a loss It's doable, but Nasdaq doesn't really respect that a lot, from my experience.
Yeah.
Especially if it's like I do not lose this amount of money in a trade. If that's the case, it should be based more of structure, and that's why, for example, me and JD, you don't usually see our stop loss on screen. At the beginning of a
Yeah.
trade, for us, it's more like if it closes below a certain point, we cut, because structure is really what indicates what price is going to most likely do. And if we do it by a set amount of capital, it is going to be one of those scenarios like, okay, hit this, I exit. Oh, but the analyst is still in the trade. I'm going to find another way to enter again. Okay, I entered here. Oh, we hit this again. I exit once more. Okay, the analyst is still in. He thinks he's going higher. You know what? I'm going to go in a third time. And oh, the analyst was long, and I ended up losing 3 times in a row, while he only lost once because of my max capital loss. And I'm sure that
Yeah,
might
I
have
did
happened to
that, I
you.
think, on Friday.
Yeah, that happened to you, exactly. So it's one of those situations where technically the setup isn't invalidated for you to be definitely wrong yet, but you're putting yourself in danger to just take in to compound the losses to the point that even if the trade wins, you're just making back what you lost. You're not really making anything back unless the risk to reward was really, really good. So 14 points is really tight for Nasdaq. I'd say Nasdaq moves relatively on an invalidated idea 25 to maybe 30 points, sometimes a little bit less if we're using a soft stop, which is in terms of soft spot means if it closes below a certain candle, if it closes below a certain area, we just cut it. We don't even wait for it to move the opposite direction. That's referred to as a stop, a soft stop. That can vary between 10 to 20, but most usually it goes from 15 to around 25 or 30 points for an invalidation of a setup. Now, the
Okay.
capital for that using 3 micros, now that's definitely different, right? If we were to say, let's say max stop was 30, with 3 micros, that's exactly around 183. Now, if you're not willing to lose 183 in an invalidation, then what you do is you size in smaller. So instead of 3 micros, what you could do is 2. Now the difference would be, oh, 122, a lot better. But let's say you still want to feel more comfortable with your 75 stop for your account, then okay, 1 micro. And it might seem small, but if you compare everything going on, if the trade invalidation were to happen, you only lose 61, which is technically adherence to your risk for capital of each trade, right? You don't want to lose more than 75. Well, the invalidation of this idea gives you a loss of 61. Now, if the idea were to be right, assuming, let's say, you go long here and you're targeting the highs, you can hold the trade till it takes that target and then you make back essentially more than what you would technically lost, 73,
Right.
which would be in this case mathematically around double, 147. So you see how you're minimizing your risk
Okay.
while also putting yourself in a situation where you're comfortable, and you're still going to make a good amount of gains if the trade idea ends up being correct. Now, I would encourage this so that as you follow us as well in your next PA, when you once you achieve it, that way you're not putting yourself in a position where you're getting stopped out many times within the same idea. You're also not putting yourself in a position where you're going to compound losses, which would not only hurt your psychology in the sense of, oh, I'm so close to losing the account, I need this idea to work out. In fact, let me ask you, do you have issues with over leveraging? Like, let's say you'd lose a couple of times, so you enter more size in the contracts?
No, thankfully I don't have that
Uh,
problem.
yes, that's a bad habit you do not want to have. So thankfully you don't have that, which is something great because that's something a lot of people have trouble dealing with. So really, in the game of math here, your exposure to risk is practically softened by a ton. You're able to lose 30 points, or let's say if you're risking 25, if you put if you're risking 25, I think you can do 2 micros and you wouldn't be, yeah, around 96. So you can kind of gauge the risk, and from the risk you adapt to your contract sizing. So let's say one day me or JD wants to take a turtle soup on a root candle. we're expecting our stop loss to be tight, you can slap 3 micros there. Or if we have, let's say, an invalidation at a certain PUA, and from your perception you see, oh, this is like 20 or 15 points, you can size adequately to there. But if you see me with one of my ideas that tend to be wide stops, like, oh, he's risking for 30 points here, nah, 1 micro. And that way, even if you're wrong, or even if I'm wrong, and you're following to the T, you don't get hurt. The next idea, you can come back, make double or triple what you lost easily. In addition to that,
Okay.
it's also important to set your stop at invalidations, because invalidation also helps you know that you're completely wrong and you do not have to look for the same move twice. In the sense that, let's say, being married to a bias, right? If you're married to a bias, you get that tunnel vision and you're just not able to get a clear trade that you could if you just, okay, I'm wrong, I'm no longer going to try longs, for example. And that way, if price keeps moving down, you're not catching the move down. You're not putting yourself in a position where you're blowing your account. You're simply sidelined, waiting for something that you like, or you're playing the opposite now that you know that longs are not going to work anymore. So that's why it's important to let structure guide you when it comes to the risk management of your stop loss, but also, like I was saying, all of the sizing and things, especially if it's capital based. Um, Other than that, when you're in a trade, do you feel like anxiety or stress?
Mm, only when I'm losing a lot. But I learned 2 weeks ago that it was starting to ruin my mood, like later on in the day if I lost.
Mm-hmm.
So therefore, I stopped. I mentally had to stop letting it ruin my day. So even when I'm in a trade now and I am losing, yeah, it does make my heart beat a little bit faster and I do feel anxious, but I take the emotions out of it.
I see.
Like if I lose, okay, it's fine.
Okay,
Just stop trading for the day or just wait for the next setup
okay, that's
rather
actually
than
great. You
feeling
know,
bad about it.
your psychology, your mental fortitude is standing nice and firm, which is a great insight because usually that's kind of trading is a two part thing. It's the psychology and then it's the actual pressing buttons and drawing on the chart part. But it seems like your emotions are in check, your psychology is in check, so I don't think we're gonna have to focus on that part. Other than the risk management, which is what from our observations is holding you back. It's another thing.
Yeah, 100%.
How comfortable are you ending a day in red? Have you ever done that actually?
Yeah, I'm pretty comfortable now. Like I said, at first I was upset about it, but now I'm okay with a negative day. Like if I lost more than I had made that day, let's say I was up, I was green for the day, and then I ended up losing the profits that I made. I upset at myself for a little bit as I look at the number, but I just begin to be hopeful for the next day. But honestly, I haven't really had that problem with you guys. I used to have that problem with the last mentorship, but here I don't really end my days in red. I typically end my days very much in green. And if I lose, like it's because of my own like staying in longer than I need to, waiting for it to come back to positive or waiting for it to come back to break even and it doesn't. So it's really not your guys' fault. It's more so my discipline that I'm lacking.
I see. No, that's also good to hear because, like I said, usually people stumble in these sort of things. So the fact that you have it in charge is great. Um, okay, at this point, then it would be kind of like price reading and model building because usually you kind of learn as you go, right? So every time you continue
Yeah.
grinding, continue advancing, you find another roadblock that stops you, and those are the roadblocks we have to overcome. Since you're rather fresh to this whole thing, there's not many roadblocks in front yet, but from what we have, I think those are some solid ideas. Now, would you like to give an example of, let's say, a trade that you would personally take? If you could stream your screen?
I could.
Yeah, that'd be fantastic. Because I'd like to see how well, relatively your mind works when you take a trade.
Yeah, no worries. Let me see. Share your screen. Right. Can you see it now?
It's loading. All right, I see it.
Okay. So I marked it out already on MenQ. And this was the system that they had taught me throughout the last mentorship. So I've only been with you guys maybe for a month. So I just mark out my levels still on the 1 hour to see how it correlates with your guys' models. And typically it does. But for example, I believe we were in this trade right here where the purple is marked with JD on Friday. I mean, not JD on Friday. Actually, it was with you because JD wasn't on there on Friday. Let me see, is this Friday? Yeah. So I had the conclusion that because there was a big volume gap right here, like I used I think it's VRVP, and this right here had a big gap. So I figured that price was going to if it kept selling, it was going to go through the gap. So I held, I believe, up until that point. And it did end up going there. So it was one of the trades that you had called, and we were in a sell. I believe it went there. Um, but basically, we would mark it off of the 1 hour if it started switching colors. So from here, it was selling and I mean buying, and then it started selling. So we marked it here, bought, then sold, and then bought, then sold. So these are reasons why I had marked them out here. Here, it went from selling to buying, and in the past as well, it bought here. And I marked it on regular trading hours. But then when I'm trading, I usually will switch it to ETH. So I'll go here and just switch it just to see the progress while the market was closed the day before to see if it still corresponds or not. But what I use mainly the gaps for, like these gaps that you see here, is more so to know where it's going to fly through. And these are usually the levels where it tends to consolidate. Here it's kind of harder for it to go through the level, but once I see that you guys take a trade and it's maybe like around here, I know that for sure I can hold it for a longer time because it has all of this space that it's going to go through. And typically works out that way. And I know you guys watch it on the 1 minute, but I'll watch it on the 5 minute just to see these little dots. These dots, typically the yellow one will indicate for me when we're in the trade already, if to stay in the trade or if to just get out. Because when it's at the bottom, it's still going to keep pushing up. And when it's at the top, it's still going to keep pushing down. And so if you guys are in a short, I'm waiting for the dots to still stay on top. And if it starts to go on the bottom and we already gained profit, then I'll just take out my profit.
Okay,
So
not a bad
that's
system.
typically how I'm looking at it.
It's, although we could trade completely different, I never discourage
Mm-hmm.
previous systems because it all works, right? There's so many different trading styles. It all works. It's all just based on your risk management and your psychology. So keeping in mind this, right? You use us as a confluence, but when it comes to, let's say that I'm off stream, JD's not really calling anything, and you're pressing buttons, how do you find a setup that you are willing to risk and take, as well as if there's any examples of a trade that you've taken within the week, if it worked or if it didn't work, uh, we could go through that so that we can find anything to refine.
Yeah, I gotcha. So an example would be this right here. Um, so if I were to be trading by myself and I'm still on at 8 in the morning, Then on Friday at 8, I had already marked out my levels, so these are still good levels. And now I go down to the 5 minute, which is how I would trade. And this right here, we used to call it a rejection.
Mm-hmm.
So it would be a 2 wick rejection because it went above, it tried to go above the level and it didn't want to. And then it tried to do it again, try to go above the level and it didn't want to. It has this gap right here. And so I'm looking for a sell now. And because it closed underneath the level the first time, I'm waiting for this second one to happen, go above a little bit, and then come past the level. And it goes on the level, that's when I would enter a sell. And I would do 3 RR. So let's say I would do 30 points at the top. And then I would just bring it up to 3. And even then, if it goes through 3, but this gap is still available, I'll hold it longer until the end of this gap around there. So that could have been like a 6 RR trade. And my risk probably would have been the 5 micros. So I'm not positive how much that would have been, but I want to say maybe about $300 or less, like 150 to 300.
Mm-hmm. So the invalidation point for, let's say, a trade idea, for example, that one would be if price is closed above the level. Did I reject it?
Sorry, mention that again.
So your invalidation point in, let's say, this setup specifically would be if price closed above the level ahead. They're rejected.
Correct. So if this would have happened, the first one, but the second one, it would have closed above the level, then no, I'm not taking that trade.
Okay. When you are in your trades, do you target any draws of liquidity? Like when we target a sell side or buy side? Or do you base it simply on the risk to reward?
We used to base it on the risk to reward because of the mentor that I had. He would test it out on the strategy and he would say that a majority of his patterns, I think he had about 6 different setups. And this just happens to be one of them, but a majority of them would run to about 3R and then sometimes they would reverse. So that's why the 3RR was the safest for us to just trade on. But if we wanted to reach a target instead of 3RR, it would typically be like right here because this is a part where it started to buy and that's just the last level that wasn't ran through or that was ran through, I would say. So
Okay.
typically if we're not basing it off RR, we would go where was the last point where price was consolidating or giving you a rough time going through easily. And that would be one of the points. But also, we would look at stuff like this. We used to call it a compression. I forget the term that you guys call it,
Yeah,
but when it's
the trend line
compressing
liquidity, the high
upwards,
resistance liquidity run.
online liquidity. Yeah, so typically right here is where it's gonna go through to. And after that, it might start buying again, is another explanation that they had.
Okay, so yeah, this would be one of those scenarios where your system would confluence with using ICT concepts. Because ideally, from the concepts that I preach and that I use, it's price is always going to the algorithm that manages price. It's always going to be distributing it towards a liquidity, upside or downside. Now, in this scenario, for
Mhm.
example, you could start trying to modify your targets. Let's say you exit majority in the moment it hits 3R, or what would have been the TP for your target or your model, and then you hold your runners for what would be a liquidity target. So in this case,
Gotcha.
the short that you enter right there, you could be targeting the actual lows of the market, as that's where sell side liquidity is left, and that could help you do more damage with runners and minimizing your exposure to risk. You can immediately, right after, let's say, price runs after 3R, you could put your stop loss at 3R. If it hits it, well, you would have secured
Yeah.
your profit there anyways, so no biggie. But if it doesn't hit it, then it's just running towards the next target, which would be the draw of liquidity. So that's one way that you can try and modify your system so that it's always following a certain draw, but it's also not putting yourself in like, oh, okay, it hit 3R, now I'm out, but I'm technically missing what could have been a lot more in my great entry, kind of thing.
Okay.
Do you have any other example?
Another example would be, let's see if I could find one. Another example would be this one right here. So this one right here, they call it a break and retest. So it broke through the level on the 5 minute and then it retested the level. It came up, it wicked, it didn't want to go back up. And you know how sometimes the price will go straight down and then a huge white candle will equal the same move that it made down. So if it doesn't equal that same move that it made down and it starts like price starts to go below the level, and this is just a wick, we would enter at the level as well. Same thing, the stop loss would still be the same, 3 points.
So this was one of those
And
that ended
then,
up failing.
yeah, this one would have probably failed if it wasn't the 3RR. So, I mean,
Um,
maybe it still would have. Yeah, we still would have been able to secure the 3RR in like 5 minutes. So this would have been one of those trades that I had mentioned. We would typically trade like stay in the trade maximum 5 minutes to 10 minutes. It would be done quickly, and we would only spend an hour watching the charts. But yeah, that would have been another one if I would have been up during these hours and trading at this hour, but this is pretty late for me.
okay.
I wouldn't really be trading this unless I was on the call with JD.
So I think that's one of those examples right there, right? It hits the 3RR, you put your stop at 3RR, you would have been stopped out at 3RR and you would have
That's it.
profited, but if it had ran towards the draw, which would have been a lot lower, would have been fine either way.
Yeah, if it would have gone here, that would have been nice.
What about a trade that you
But it didn't.
feel that you could have done a lot better when it came to managing that was just wrong?
Um, Typically that'll be something similar to this. Let's say this one went all the way down and I entered here, but this candle ended up closing above the level. Sometimes I'll do that, and although I was already in the trade, I already got my 3RR, I was greedy. I wanted to stay in longer because I saw this here and I wanted to target down here. My greed would typically fail in this sense because of how you said it closed above, per se. And I'm waiting for the next candle to keep going back down, and it does. But then it doesn't go all the way down here again. I'm still in the trade, being naive, and it starts to move up. So that's what's happened to me in the past a lot before. Just me being naive and greedy. A lot of it is just greed, wanting more money, and thinking that it's going to take out all of this, and it doesn't. And it just runs up. And now I'm negative. And now I'm debating if to close it or not. And then it just consolidates, and yeah, I'm not gonna wait all of this for it to consolidate, for it to go down, because I think we have to close our trades after a certain time too, don't we?
Yes, I think it's at 5. We have to close it, wait an hour until 6, and then you can open again. Okay.
Yeah,
So
so
this
this
would
would have been one that would have been bad for me
Yeah, this is
if
why
that would have been
it's
the
very
example.
important to have your rules set. Like if a trade is invalidated, do not hold it. Overholding a trade is what damages your account the most, and also being stubborn. Ideally, it's always about taking the kick to the teeth, accepting that you're wrong, and then moving on for the next setup that would be adequate for you. Uh, I think that's something that you won't really have much issues following, as long as you keep reminding yourself that okay, if uh, if what I needed to see happen did not happen, just be out. You're just gonna tell yourself if
Okay.
it didn't happen, because there's ideally a plan that we all have in our head going on whenever we're in a trade. We want to see this, this, and this happen. But if it's not happening, you can't just wait for and expect the market to just abide by your wishes in the head. It's never going to do that. It's either you visually see it come true, or if it doesn't, you immediately just run out.
Okay.
Because, well, you overhold it and then you end up having a lot of drawdown. There's not much to explain other than the obvious from that part.
Mhm.
It's an interesting system you got. There's definitely some things and traits that you can add to it that would definitely refine it. Thankfully, with everything that we do here, there's absolutely so much more room for your system to grow and become a lot more of a great weapon. Uh, I don't feel like there's anything specific to mention about your psychology unless it slowly starts to grow into you as you do your new PA. But definitely one of the most important things is especially to know your type of day. I'm sure in days when there's search and destroy, which is when the market just kind of aimlessly pushes up and down without going for a draw of liquidity, I wonder how your system would do there. But in any scenario, either it be with big news within the week like NFP or something like that, be mindful to limit your trades. 1 to 3 trades a day. Your stop losses, as we spoke today, how to manage them better, especially with sizing. Because again, there's also those days when Nasdaq is just really, really volatile. One candle moves, let's say, 50 points, and those days can also hurt an account pretty strongly. So an encouragement would be
Oh
that
yeah.
every morning when you start, you kind of put a little measuring tool on the chart and see, okay, well, we moved so many points, so little points within this 1 minute candle. Is it volatile enough for me? Is it not that volatile enough for me? If it is very volatile, limit your sizing. Have adequate risk with smaller sizing than usual. If it's not volatile, then actually if it's really not volatile at all, then you feel like, okay, yeah, I can potentially add more contracts instead. You can also do that, but it's important to just know what the playing field is and try. If you're engaging into it, you want to make sure that you are under the best circumstances that could aid you. As you learn to kind of
Okay.
use the models that JD and I teach for your system, we could go over some of them if you'd want right now, but I think there's so many other videos you could watch and then develop your questions from it that would help you the most. Is there anything specifically right now that you would like to ask?
Yeah, more so what videos should I watch? That's my first question.
Okay.
Specifically from your mentorship. 'Cause I watched the last two that you had uploaded. But other than those two, are there any specific dates that I should go back and watch?
I think the one-on-one that I did with Bossman was pretty good. I think you could watch that since that went over how to find a model and it went over the very simplest model, which I think would be great for you to use as well as try and guide yourself with. Other than that, I would also hop onto JD's quarterly theory education and root candles because combining both of those things together make a really neat weapon. And I think that your system with that would also not you don't really have to remove anything. I would say just would add on to what you're doing, which would refine it a lot more. So those would be the main things. And if you have any doubts or questions after you watch those two sections, then you can definitely come back and be like, hey, Tyrant, I have some questions. You can just message me in the DMs if you don't want to do another call like this. And we can talk about it. I could explain some things. Or even in stream, you could ask specifics. Another video, let me see which one would be good. Would be I kind of been a bad teacher. I haven't been recording all of the things. Let me hop on the
It's
YouTube
okay.
and see, because there's where I have the little titles.
Michael. Mike.
Um, And I'm gonna send this. I'm gonna send it here, but you should also do this one. So I sent it in the chat. So those would be the ones that I would focus on right now.
Okay.
After that, and after you incorporate it in your system, because one thing is, you learn it, and then the other is using both of them at the same time, seeing what works, seeing what doesn't, remove certain things that don't work, that hinder your progress, and keep the ones that promote more growth into your system.
Okay. My second question also would be, I think it was maybe on Friday morning. You were in a cell already, and I got in there late, and it was running really well. So for situations like that, when you're already in a trade, and I hopped on the call late, but there's still a possibility because there's pullback. Sometimes it'll buy up a little bit before it keeps going back down. So if that happens, could you give me an example of where would be good to be able to sell so that I keep on
Absolutely.
selling with you?
So let me pull up my screen now. Okay. So when it comes to situations like that, we're always going to see those pullbacks, like you mentioned, retracements. So in prices like this, ideally, where you want to, I don't really average up. I'm trying to get better at it myself, but every retracement you want to ideally average up or add for the great draw of liquidity, which should be the target where you're aiming for. In certain scenarios, like let's say the short that I was in that ended up succeeding, like on Friday, that was, where was that? It was right here. Okay, in this case there was no retracement, but the kind of rule of thumb is when you miss a move and you know the draw of liquidity is to be hit, like it's obviously going to take out this low, there's no way it doesn't, but you really want that entry, the overall recommendation is two things. One, if you're going to enter, make sure it has not taken out liquidity before the entry. And the second would be make sure it has not expanded beyond 50% of the range. Now, how does that look visually? Visually, that looks, let's say this, for example. That looks like this. So the range from point A to point B is this way. The 50% is this right here, right? This is the 50% of the range from point A to point B. Let me just make sure this is graphed out so it doesn't get too confusing. There you go. 1 to 0. This is the range. This is the 50%. If you're entering a trade, you want to make sure you enter when it's not beyond 50%. If you're entering after it moves 50%, there's a chance where you're kind of exposing yourself to additional risk. And in those scenarios, it's recommended that you do not use a hard stop, but instead use a soft stop. Because let's say I entered short, well, let's say I entered short right here. Right here. If I'm entering short right here, my invalidation point for the setup, let's say it was this inverse right here, that was the reason I entered, should be the swing high, right? This is my invalidation point. Because after, if it takes that, it's most likely going for this high. After it runs through 50%, you can see that there's definitely reasons for why price could retrace all the way up here, but in doing so, it might be overexposure for yourself. In the sense that if it comes all the way up here, it's still not the idea, even if it pushes up here, it's not going to be wrong because the invalidation point technically is still up here. So you can't rely on having this as your stop because it's just too much drawdown that you'd be exposing yourself to. So instead what you could do is make this your soft stop, in the sense that if this becomes invalidated, it is likely that it's going to come up here, and that way you can cut here and avoid the extra risk. Similar circumstances in, let's say, if you want to take a trade beyond the 50% range. So at this point, price was beyond the 50% range. It was here. Because it's beyond, there's obviously the risk that it's going to come.
So I wouldn't be able to enter.
here, right? So with
Right.
keeping in mind that risk and keeping in mind that even if it comes here, the setup is not invalidated, it can still sell out down, you might want to, instead of holding those 22 points of drawdown, make it a soft stop that if it closes above this PD area, you cut for 5 instead of holding for 22. And when it comes here, then you see if you want to enter or not. Again, but you're limiting your exposure. You're putting yourself in a spot where you're not going to withstand so much drawdown. And you're technically not really chasing because it hasn't taken out the draw of liquidity yet, which is what the other point was. If price takes out a liquidity, the odds of success for continuation or for distribution towards the direction, unless it's like a high time frame setup, becomes a lot less probable. So in a scenario like this, let's say you missed the entire drop and it already took sell side, would it be wise to short this here? It could work, but I personally would never, because it's already at a point where it's a lot more riskier, and in a point where it can literally reverse against you, and if you do not have a soft stop, you can get ran through. So that would be my recommendation. If let's say you're late to a trade, if you see that it's not beyond the 50% range, you can take it. If you see it has not taken out the target yet or an internal target, you can still take it. But if it's done both of those things and you still want to take it, be mindful that the exposure of risk has become a lot greater and the probability of continuation isn't exactly there. Now in this scenario, right, if you had entered here and you put your stop at break even, you would have been stopped out of break even before the run. It would have been one of those unfortunate scenarios. But just as much as they did that right here, this is an example of, let's say, a failure one. You enter here, get ran through, close for a loss, and then you miss out on the move. Because this got invalidated, you enter right after sunset and beyond 50%. And that's why, let's say, another good trader, I'm not sure if you've seen him around, but Soy Sauce, he never averages up after it runs 50% to his target because the probability of price returning against you increases each time, the further it is away, in something called premium and discount. So the way that that works, if you haven't heard of it, is price is always going to go from a discounted area to a premium area. So from down to up and vice versa. If you're ever thinking of entering longs, you want to enter long when price is cheap, right? So at a discount. If you're ever thinking of entering shorts, you want to enter shorts when price is expensive, at a premium, because that's where people are
Got it.
willing, are less willing to buy longs when it's at a premium. And that's how the system kind of works. If we're all the way down here, then it's less likely that people are going to be shorting here and the price might just period right here for a little bit and then continue going lower if it is really bearish. But if it's not bearish, this can be the final point before a full-on reversal. Did that help answer your question?
Okay. Yeah, and then my other question is when you're talking about averaging up, does that mean adding more contracts?
Yes, that means, let's say, for example, right here. Averaging up is in the sense that you enter, let's say, 5 micros and price is going your way but retraces a little bit, so you add one more micro. Keeps going, retraces, you add another micro until it hits your target because it continues respecting every PD rate. So let's say, what's this far? Let's just imagine there's a sell side right here, right? Let's just imagine this is a sell side. It's not really one, but let's just say it is. Your main entry was up here. Price drops, then retraces. You're feeling really confident that price is going to go back down there. You add a little bit more here. Price drops, it retraces. You're still super confident that it's going to continue going down. You add a little bit more here. You don't add more than your original entry, but you do add a little bit more every time that there is another swing point so that it accumulates a lot more gains. And eventually, if you entered 5 here, you have 6 here, you have 7 here, you're going to have a good sizing so that when it hits the target, you're making a lot more profit. But that's something I would recommend you kind of experiment once you have your refined, firm system to do.
Okay. In the meantime, would it be better to take contracts out as it keeps going down?
Yes, scaling out would
Secure
definitely
my
be the best move.
profits.
Or like I was telling you, if it hits the 3R, you put your stop loss at the
Uh-huh.
3R, and you let it just run till the draw of liquidity. And every time it takes out a buy side or a sell side, you scale out. Or if I scale out, or if JD scales out, you do that. But you always have your stop loss at the 3R, so that even if, let's say, we are wrong, you made your money from your system, so there's no loss.
Got it. Okay.
Any other question?
No, sir.
All right, then I hope you enjoyed this session and you learned some
I
insightful
did
things.
indeed.
It is a pleasure to have you here at Kingline. I hope you enjoy it and you find everything you've been wanting. If you have any questions in the future, you can ask me or JD. We're always available to you. Or if you want to schedule another one-on-one whenever you feel like you've had a hiccup or you want to talk about something specifically, you just gotta ask Ken and we'll set that up right for you.